this as an indication we're likely to have a recession in the near future?
I think there are a couple of things that have gone on over the last couple of days that contributed to the market volatility, we've seen really since Friday. The first is the jobs report on Friday indicated a slightly softer trajectory for the US economy than people were expecting. I think it's important to pull back at a high level and just recognize it wasn't a horrible job report. It was just softer than people were expecting. And employment levels still remain pretty robust. But it certainly took market participants by surprise, is what I would say. And market participants have been well levered toward a very soft landing. And I think they now discount that soft landing a little bit more than they did prior to this one reading. The second thing that happened is the Bank of Japan tightened rates, tightened monetary policy for the first time in a long time. Money has been very, very easy in Japan, and investors around the world have basically been borrowing in yen and investing in US treasuries and getting a nice carry on that trade. And based on the Bank of Japan's movement, a bunch of investors began to unwind those trades. So all that created a little bit more market uncertainty and a little bit of volatility. But I wouldn't call it extraordinary by any means. I do think that we're getting a correction here after a very strong run in the markets, and that might be healthy. In terms of your question about a recession, our economists have upped their chance of a recession to 25% from 15%. All of that I think is a little lower than the broad consensus. My view is that the best chance as we look forward is, the economy will chug along and we probably won't see a recession, but the possibility is not zero. It's never zero.
Do you think there's a lot more pain to come in the financial markets, or are we basically avoiding a hard landing, so-called, and likely to glide through this for another year or two without any hard landing?
I think we're going to see more volatility in the short term here. This was a pretty big, pretty meaningful correction and a big unwind of leverage, as we have discussed, in certain parts of the system. My guess is we'll see a little bit more rebalancing. But my base case is still that there's a good chance the economy is still in reasonable shape. As we said a few moments ago, the jobs report, while it was disappointing, wasn't a bad jobs report. The unemployment levels are not bad unemployment levels. And so my base case is we're still set up, to kind of muddle through. But I do think in the short term here, the next couple of weeks, we might see a little bit more market volatility as this all rebalances.
Before yesterday, you had earlier said that you thought one or two rate cuts would be appropriate in September or before the end of the year by the Fed. Do you still think one or two rate cuts are coming, and should we do anything before September in your view?
I don't expect that you'll see anything before September. We do have a long period now. We've got 40 days until the next Fed meeting, which actually I think is a reasonable period of time for the market to digest more of the news. I'd say the market expectation is certainly for cuts in the fall. I've been more cautious around interest rate cuts all year. As you remember, the market expectation early in the year was for 6 or 7 cuts. Based on the economic data we're seeing now and the messaging from the Fed, I think it's likely that we'll see a cut or two in the fall. But I think you've still got to wait and see as things unfold. And, the economic trajectory over the next couple of months and additional economic data will certainly have an impact on that. But the Fed's in a position, David, that if the economy does soften, and I think there are some data points, I've said this repeatedly, I think there are some data points that consumer behavior is softening a little bit. The Fed has the tools or the resources at this point to kind of bolster or cushion that. I think the Fed is an independent body. It has to act independently. It has to look at the data. Election timing shouldn't factor into their decisions. And I don't think this Fed's making decisions in any way, shape, or form based on politics. The M&A market is actually doing okay. But to your point about coming back, and we talked about this a little bit when we were talking about the equity market, M&A volumes are running kind of 20% below 10-year averages. There's no question that the regulatory environment has an impact on that. And I don't think the regulatory environment is as constructive and balanced as it should be, to ensure our competitive position in the world. And so I hope that adjusts. I think it will adjust, naturally. I think the second factor that's impacted the M&A market is the financial sponsor community, the private equity community, has been a little bit turned off over the last 2 years. And I still think, we've got a big reset coming out of the pandemic. And I think the private equity community is still wrestling with the value they perceive their assets to be versus the current, kind of market value. And the incentive system really leads that community to wait. So M&A around that, the sponsor community has been slower. I think both those things will normalize over time. There are natural cycles, but both of those have been headwinds to M&A activity in the short term here. We've used artificial intelligence to serve our clients and to operate the firm for decades. What's changed is the accessibility of these large language models and the power and the speed of the compute that's now available on these new GPU chips. And so I personally think, and I've said this publicly before, David, that this is going to accelerate a change in business processes that's going to be quite significant. And I think that's starting to happen right now.
So some people have said AI is a bubble. We're in a bubble because people are fascinated by AI stocks and so forth. Would you call it a bubble or just maybe a modest correction we've had lately?
I would not debate that whenever you have something new that's exciting, that stock market valuations can get ahead of themselves, and can run ahead, but then ultimately adjust. You and I can go look at, all sorts of things over our careers where we've seen that. But AI as an expanding technology, GPUs, increased compute capacity, the ability to use this in business process, it's not a bubble, it's a trend that we're in the early stages of seeing how it implements and affects business productivity. Valuations will go up and down. I'm not smart enough, to call tops and bottoms.